Well, hello and welcome to the Personal CFO's Expert Speaker Series, How to Work with Your Lender and Drive Business Growth. My name is Tina Karthagazer, and I'm a partner and marketing director here at Advice to Advisors. We have some great attendance, so thank you so much for tuning in today. Just before we get started, I just want to share a little bit about us. Advice to Advisors is a training, coaching, and mentoring firm that helps advisors grow their businesses. Training the technical and using that confidence to prospect is at the heart of everything that we do. A few housekeeping items to cover today. We'll be taking questions at the end, so please use the Q&A box at the bottom of the screen to ask any questions. If at any time you're experiencing any technical difficulties, just use the chat box and let us know. And with that, I'll pass the virtual mic over to you, Dan.
Beautiful. Thanks very much, Tina. Hello and welcome. Good morning, everybody. Good morning to you on the West Coast. Good afternoon to everyone else. Glad you could attend. This is our ongoing series on the Personal CFO Expert Speakers Series, and we've got a great informative session for you today. So we're going to jump right into it. And for those that aren't aware of the concept of the Personal CFO, I just want to go to the really important reason that it's so important today. First of all, research shows, and this is very up-to-date Accenture research that shows globally, the consumer wants a one-stop shop. They want somebody that can take care of their personal needs. They want integrated planning. They don't want to be out hunting for all the experts. They want it all taken care of them. We've seen this with our coaching clients in Canada and the US. We're doing some work down in South America, and the same is happening there in South America as it is in Europe. Consumers want it made simple. And for financial advisors, simplicity comes with the concept of the personal CFO model. And really, you can take this concept a long way. For any of you that may or may not know Moshe Malevsky, Moshe is a finance professor out of the Schulich School of Business where I teach. He wrote a book a few years ago called Are You a Stock or a Bond, where he posited the idea that Canadians really should be treating their personal finances like companies do. Companies are very effective, they're very efficient, and he termed it You Inc., You Incorporated. He said it's a small, tightly controlled, privately held company, and really, it's all about you, your human capital, your ability to earn, and what you do with that. So what Malevsky said was that you, the Canadian family or individual, should be acting as the CEO, the chief financial officer, even the chairman of the board of You Incorporated. But here's the problem, which I'm sure everybody listening to this webinar understands, is people don't have the time to do it. They don't have the time, they don't have the inclination, and they most certainly don't have the expertise to take on the role of the personal CFO model. So what we do look at is, okay, we can give them Malevsky's CEO position, You Inc. So if we're talking to an individual or a couple, there's a CEO or co-CEO. Our job as a financial advisor is to act as their personal CFO. So we've got a couple things we've got to do. As any CEO does with a corporation, their job is vision. They look out, here's where I'm taking the company, and for your clients, here's where I'm taking the family. So I need to help them qualify their goals. I need to help them quantify, put time and money. Then as the financial advisor turned personal CFO, I'm gonna take the strategies and the structures I need to help build out for our clients, those CEOs, and I'm gonna have to bring the experts into play here. The one thing we do understand, and certainly the public understand, is no financial advisor knows it all. In fact, the research suggests that the more you attempt to suggest that you know everything, the less you're able to garner from your prospects or existing clients. So by letting them know that you've got a field of experts, especially these top 5 experts that you call on regularly to help you help your clients. And the reason I say you need these experts, because in every realm, in every area of expertise, there are subsets of expertise. And today, obviously, we're talking from the lending side. We've got Calum Ross, who's going to go through a lot of what he does with his clients and with his advisors and their clients to help them out. But this is a phenomenal quote that came from an advisor out of Ottawa. He said to every new client that opens up an account with him, he says, if it's got a $sign in front of it, call me. And what he's really saying is, don't let the competition in. right? If something happens, you need my help, whether it's a decision you want to make about, do I buy my car? Do I lease my car? Do I go short? Do I go long in the mortgage? Whatever it is, call me. I've got the experts. I'm not going to be able to give you the answer necessarily immediately, but I've got the experts that will get the information. You can save a lot of billable hours when you're dealing with accountants and lawyers, but you can also bring them to the table when any of these experts need to do drafting or get their hands dirty, get the work done for the clients. What we always do in the series is give you a few prospecting questions to help you get out to market. It's great to have all the technical knowledge. It's great to have all these experts at your beck and call to help you with your clients. But if you're not out prospecting, you're dying. It was interesting. I was just talking to a coaching client yesterday, and he said the same thing that I've heard for the last 30 years when I said, so what are you going to do next week as far as prospecting? He said, well, I've just got to do some more reading on these strategies. And I said, well, that's how you end up dying in the business. The reality is we've got lots of time to learn, but if you're not out prospecting, you are dying. It doesn't matter how long you've been in the business, you've got to be growing your business. So the concept here is to take an area of expertise that you want to pass on vis-a-vis a question to your ideal client profile. Something when we're talking about the debt side, it's something as simple as, has anyone ever shown you how a debt swap works? And we know as a fact that very few consumers will ever be able to say yes to that. Turning a non-deductible debt into a tax-deductible debt. Ask them something, has anybody ever shown you how the Smith maneuver works? Has anybody ever shown you, rather than using a middleman to buy a tax shelter, has anybody ever shown you how to create your own tax shelter? Invariably, the prospective client you're talking to is going to say, no, what's that? I haven't heard about that. And then you just say, well, why don't we set a time to get together, maybe over a coffee, 20 minutes, and I can see if any of these strategies actually make sense. And then once you've done that, leave it to about 20 minutes, get the information, show them what you do, disturb and motivate them, disturb them to what they don't know, motivate them to move forward with a full discovery meeting with you. That's how you use these technical prospecting questions. So let's get into the real meat of it. I've got the distinct honor to bring Calum Ross to you. Calum's a best-selling personal finance author. He's a regular media expert. Any media that you get through Canada, you've probably seen Calum on it. He's a winner of numerous industry awards, top mortgage broker in the country. And he's somebody that I've known for, and we were just talking about this the other day, just about...
Don't say it, Dan.
I can't help it. As you mentioned, I had a full head of hair at the time. I was teaching at Schulich. Calum was doing his MBA at Schulich School of Business, went on to Harvard. He's done his work at Harvard as well. But he was one of my very few A students that got through the course, got his MBA, went on to build an absolutely fantastic business in the lending world. And we've got him here today. So I'm going to turn it over to you. Calum, take it away.
Perfect. Well, listen, thank you so much for having me, Dan. Just so you guys know, too, when he said 20 years ago, it's because he babysat me before I went to MBA. But it's funny because Dan's smiling now, but anyone who had him as a student. So I was doing an MBA in finance. Interesting. So you got to remember at Schulich, every one of the kids there has essentially got, 90th percentile in their GMAT. They got their A- average in undergrad. We always had this sort of grandiose perspective that we were as good, if not better, than a good portion of our professors. And I remember all of us taking this MBA finance course thinking this would be one of the easier electives. And Dan comes in and they starts to parlay his information and his knowledge within the first couple of classes. And all of a sudden, all of us were eating humble pie. Dan also used to make us do a quiz every week. And to your point, it wasn't until I got to the end of the semester that I actually even knew if you liked me or didn't like me. But yes, he did not give away a lot of A's. That was not one of my easier courses. So thanks so much for having me. A couple of things I want to mention is I've always believed that a mortgage professional's job is to integrate the mortgage and the short and long-term financial goals. And at the same time, I want people to realize when we're looking at this chart, it's important that we realize the client is the CEO, partially because we're serving them. Our job is to make them money and make them look good. And, I view myself as a servant, and my job is to ultimately make sure that my clients and my referral partners look good along the way. Now, Dan had talked a little bit about the lending piece, and I want to make sure we go through it at the next level. So first and foremost, the key products for mortgage lenders nowadays are really mortgages and home equity line of credit. Now, there's a subset of other products here around, personal loans, business loans. You're looking at the lines of credit, investment loans, even leasing. But nowadays, with personal lending and business lending being a lot tighter, and lines of credit unsecured being so much tighter, almost always the home equity product is the cheapest one. And of course, we've got a lot of people who've got a lot of net worth tied up in their home. It's the cheapest source of borrowing, and it creates the same type of tax advantages and things as we roll forward on this. So it's important for people to realize that these other products in some ways have become somewhat antiquated with the evolution of home equity products. So at the beginning I say, what do I say? And I think for me, I was trained by a guy named Todd Dunk in California, and I realized that, it's, for me, a lot of people think I'm in the mortgage business. I really don't see it that way. In the process of arranging the mortgage, I'm essentially helping someone create up the largest debt in their life, and I believe I've got a personal responsibility to help them manage that debt, which builds the longer-term relationship. And obviously, with that longer-term relationship comes up the simple truth that Dan's got up on the screen here, and that is that if you're a financial planner and you're not actively working with a lender partner as a key stakeholder on your core team, you are definitely losing the opportunity. You're losing assets coming in, you're losing potentially incremental assets, and more importantly, you're disrupting your client experience. Now, even if you're one of these investment advisors or mortgage professionals that works in a big bank and you've got these other experts, challenge is they might not be consistent around your branding, your client philosophy, your core ideology. And the current market realities today is something that we want to spend a lot of time with. So, all of us, I know that I've got a lot of my mortgage industry peers and other people on the call. And the reality is that, investment management revenue, the mortgage revenue, insurance revenue, all of these things are being compressed by AI, digital finance services marketplace, right? And I pause on this because, I've got the three finance degrees and more than 7 years of post-secondary finance education. And our value proposition as financial advisors early days used to be our ability to use spreadsheets and calculators. And nowadays, I mean, my gosh, if I was in Dan's personal finance course, I wouldn't be able to remember the formulas anymore, because nowadays the idea of doing something longhand or otherwise has become antiquated. And so with the technology evolution, our value proposition from financial expertise has now moved to customer service and holistic financial planning expertise. And the reality is, for the financial advisors who are attending this call, we all know that you have mortgages, but you got to realize, and this is really important that you pause on this, that every time they buy, sell, or refinance or renew their mortgage, your AUM may be put at risk. So let's roll on the next slide, and I want to talk about that a little bit. So this is because in Canada, as we know, our big banks are quite profitable. When I go down and speak to the US, they're like, isn't Canada, is that the place where like the 5 banks control the whole market and it's like an oligopoly like OPEC? I'm like, kinda. Yeah, so it's important because you got to realize that, they have invested a lot more money in predictive fintech and long-term net present value of clients than almost any country in the world. And what that means, so take, for instance, last week, I went in to get a deposit for a transaction that I was doing. And they immediately started to ask, are you buying a home? Are you doing this? This is a front desk person. This is not, your private bank or your thing. So they've gotten that good. And then we've got other forces like, the big players coming in, places like Wealthsimple, they're coming in with the understanding, they're coming after all our revenue bases and all our different types of the auxiliary products. And, they're coming in with the intention of they're okay with losing money because they're in it for the long term. So I point out these key market dynamics because I want us to be super mindful of the fact that, the big banks have also significantly improved their cross-platform and incentive compensation for off-channel sales. So in a more simplified message, it's the simple fact that we now have a situation where, they've got flags that go on checking accounts for types of transactions. They've got situations where people like me walk into a bank branch and they've gotten really good. So if I think back when I went through the management training program of a bank at a head office, these types of models they have now were folklore legend. They were fiction. They didn't exist. Whereas today, you've got situations where not only actually do they have those systems to predict them, but you've got the individuals looking for them. They're trained on the cross sell. They are trained in putting in touch. And in many cases, they've even got the compensation. So they are actively looking at it. And obviously alignment of end user interest, where these people have a responsibility to sell them, either to maintain their employment or generate commission, means that if you've got a client and you're with an independent firm and you let them go to a mortgage advisor, there's a good chance they go elsewhere. And I'm going to tell you right now, for myself, imagine someone comes to me and they're not working with a financial advisor I know. You got to think about, if they end up in someone like my desk, what's going to happen to your relationship? Because make no mistake about it, obviously I want them working with a financial advisor that I work with. Okay, now the direct value add partnership for mortgage people, I want people to really think about this, not just from a profit standpoint, because I fundamentally believe that from our standpoint, we make profit by serving others and adding value. But I want to make sure that people realize that there's incremental revenue to advisors through the client service enhancement. It's really simple. Really happy, satisfied clients stay loyal. They refer their friends more likely. But the other thing too is, and again, I won't get into the compliance piece, there could be an opportunity for that mortgage person potentially, or those mortgage areas, to supplement some of your marketing budgets. And depending on the compliance element, you could even have it properly disclosed by the mortgage person, and it could generate auxiliary revenue to you. But my inclination is, again, that incremental revenue, the real value add comes from the number 2 point, which is the opportunity to increase your client loyalty and assets under management via real estate asset review. So what I mean by that is that, whether your client's buying a real estate investment property, or they're actually coming in and they've got a renewal. Last week, for instance, actually 2 weeks ago, one of the financial advisors I worked with referred a client who was going to take a bunch of money out of their investment account to buy their property. And when I went through superficially the idea of the opportunity cost of pulling that out of a TFSA, or pulling this, in this case, a fairly well-off individual pulling it out of the RIF, and they looked at the opportunity cost and the real hit to their financial plan. When I dialed their advisor in, they subsequently put down a much lower down payment because money is cheap right now, and the opportunity cost was missing. Now, again, I'm not overstepping on the financial advisor, but you want to be working with a lender who's got a key ideology, same type of philosophy, and most importantly, they have a functional understanding of the actual the integration of the financial plan from a lending standpoint. The third category here, and by the way, we're all with it here, is that we know there's a huge percentage of the Canadian population, and I don't care what city you're in on this call, we've got people who are real estate rich and retirement savings poor. And when Dan and I first met, and I actually knew a guy named Fraser Smith that Dan had talked about earlier, back then it was basically rich people who used home equity to borrow and invest. I mean, everyday people. But if we look at the modern day client life cycle, that actually may very well much change from the idea of people potentially using leverage to fund their retirement to people actually needing to, because it's just the cost of homes and some of these other things that I'll touch base a little later on. So this is what I'm talking about when I say real estate rich and investment asset poor. Now, keep in mind, as Dan mentioned, I mean, my book on real estate investing is a personal finance book. One of the things it says at the beginning is, real estate investment is not really to it. You want to make sure that you take advantage of your tax sheltered growth first. But if we look at the traditional life cycle of a client, the life cycle model that I believe we might have taught in MBA, I can't remember sorry, Dan, I got the textbook in my back office here, but
perfect. Yeah.
The traditional client life cycle was, early days, they're in their 20s, they might get married in their, mid to late 20s, then they're going to have kids and they're going to be cash flow negative in their 30s, their 40s, they finally start to get some critical mass. At that point, they try to pay down their mortgage to a good degree before they actually start to build their investment assets. Now, whether you're a financial advisor on this call or a mortgage professional, we understand time value of money. And this is one of the things that I cover off in the first chapter of my book. And it's really important that people understand the momentum of this, because by the time you consider the tuition is more expensive today, And then you consider that homes are massively more expensive. And then you consider people marrying later, they're having kids later. And of course, 50% of those people are getting divorced. If you follow that through, you wait till you pay off your student loan before you buy a home, and then that home's got a bigger mortgage, and then you're marrying later, you get a divorce, you're giving up half your net worth. And then of course your kids get to the point where they're starting to go to school and your tuition's more expensive. So it starts this very different virtuous cycle that essentially makes it effectively impossible for people to save for their retirement plan if they followed the old model before. And that's because of shifting lifestyle preferences in conjunction with the changes in the financial cycles and other things like that. Okay. Now, here are some unique ways to increase for lenders to increase their advisor revenue. Now, I'm not going to go a deep dive on these, and obviously these are some of the things that you cover off superficially in some of our financial planning courses. I know it's something that Dan covers off on a much deeper level in his book, and certainly for his one-to-one coaching with his financial advisors. But you look at the first one, which is the opportunity to increase loyalty in AUM via real estate asset review. That's what I talked about. Every time that person's coming in and doing a transaction, it's a natural type of opportunity for you to involve your lender and make sure that when that person gets their mortgage elsewhere, you're not under threat. And people need to be mindful of, should they be paying down debt or investing, and dialing into the financial advisor and making sure. We all have two fundamental limitations. One, we all have a limited amount of income. Second thing we have is a limited amount of capital. And for a lot of people, that capital is tied up in their home. Second category, and again, this is coming from a real estate investor, I've heard, the vast majority of real estate investors do not understand yields. So after I put my book out, one of the things I commented on John Chevro's website was the idea that the vast majority of real estate that they call real estate investment within Toronto and Vancouver actually was no longer real estate investment. It had reached speculation grade, because as much as they own that real estate and they'd done well, they did well because of a higher leverage rate, principal pay down, the fact that they had unrealistic appreciation. But if you look at a disproportionately high number of the real estate investments within Vancouver and Toronto, their yields are effectively lower than good dividend paying stocks. So while they've built net worth in those areas, the truth is that if we come back to that idea that we all have a limited amount of capital, they could actually use that limited amount of capital, deploy it in other areas through managed money instruments or other things, and actually do much better. And I would even argue to some extent get a better risk adjusted rate of return. But this, again, you want to have a functional understanding of these areas, but you don't want to overstep it. The third one is debt swaps, right? I mean, the idea is, if it's pretty easy in Canada, and certainly a huge portion of the people on this call would be servicing clients that have that, upper 5, 6, maybe even 7-figure income. You start to get that tax bracket creep, the combination of federal and provincial tax, and you take a look at, you sit back and, as a mortgage lender, a financial advisor, you get all these online places offering low rates, and you say, well, basically, almost all the people we serve are sort of at a 40% tax bracket or above. Now, you show me an online website that can decrease the average cost of mortgage rate by 40%. That just doesn't exist. Now, keep in mind, a lot of people might not do this, but I've never once, and Dan, you can correct me on this, I've never once heard of a financial advisor being fired because, I'm sorry, I can't work with you. You really know too much. You try to be too purposeful in being proactive in saving me and my family money, and it's weirding me out. And I point this out because our job is to acquire intellectual capital and keep on building and keep on investing in ourselves. And I ask the people who are on the call that are here, if you're a financial advisor, how much do you understand about functional part of mortgages, and how deep diving are you with your mortgage partner and your lender? If you're a mortgage advisor on this call, have you taken a functional personal finance course so you know these things and you can teach them to your mortgage clients and or work with financial advisors to help them grow their business? The next one is cash damming, and that's for sole proprietorships and businesses. And that's using your business loan to pay expenses instead of revenues. So effectively what you're doing is you're increasing your tax deduction on the loan and simultaneously keeping your tax rate low. The last one is the Smith maneuver, and that's a debt conversion strategy where you're taking, bad debt and converting to good as time goes on. But if we look at 5-year money today, being around, let's say for simple math, 2.5%, and someone's at a 40% tax bracket, Well, that tells us that their after-tax cost of borrowing is, 1.5%. And, all the people on the call, you don't require, to be a Dan Collison of the world or have an MBA from in finance from Schulich to be able to get an after-tax rate of return of 1.5%. I mean, and that's a simple math thing, right? If most people understood the opportunity cost of capital, keeping in mind that, we all have that limited income, and most people don't realize their single biggest expense. If you ask people, they'll start to say their mortgage, they'll say their car, maybe their ex-wife or husband. The truth is their biggest expense is Canada Revenue Agency. And, we're not talking about the tax evasion here. We're talking about structuring your life in a tax efficient manner. And lenders and financial advisors working together are uniquely positioned to do that incredibly well.
Yeah, and I think it's important here, Calum, to point out that most of these strategies have actually gone right up to the Supreme Court of Canada and have passed through because the Tax Act does allow Canadians to restructure their personal finances legally to better themselves. So as long as it's done legally, and this also is where the financial advisor and the lender working hand in hand, that's the beauty of these technical questions. The prospect, the individual, cannot answer them because they've never heard of these strategies. All you're looking for is that chance to disturb them to what they don't know, that opportunity to motivate them to sit down with you. Again, if you either the lender or the advisor, and that's why you've got to know both worlds. And the best advisors, the best lenders do live in each other's world, but they're experts in their own worlds for sure.
Absolutely. And this is coming back to, it's ironic because when Dan and I were dialed back in, we were talking about the Accenture report, and he actually used it in his core curriculum. But, it's important that we realize that this is not, a sales proposition. This is not something that, we're being manipulative. This is fundamentally something consumers want. So the most current survey on this was the 2019 Accenture Global Financial Services Consumer Study. And it said that integrated propositions represent a major opportunity to, financial service providers, and that, in fact, surveys actually showed this by more than half of the respondents. So it's important for you to realize that not only is it a bad customer service experience for them to go elsewhere, you're risking, the advice the person advises in a different way. You're also risking, potentially losing a client. And this is something that consumers want. So, if you're a financial advisor on this call, I would suggest that you start to share this template here. If you work with a lender, if you don't work with a lender, it's time to start dialing in and thinking about, how can you be more purposeful about this? Because, the real estate values are not going to fall quickly. Mortgage amounts are enormous. And it's very, very important that we be mindful of the shifts in the client life cycle and thinking about how do we offer integrated propositions through strategic alliances to create a more cohesive experience and ultimately add more value around the financial education and ultimately help our clients achieve retirement, which is, having enough money that they don't have to worry and hopefully don't have to have a part-time job in retirement. So I'm going to ask people here, when they're referring over people, how are you doing it? So if you're a lender, how are you doing it? If you are actually, a actual financial advisor, how are you referring your partner? Because you want to make sure you're positioning that person as an expert. And by the way, I'm not suggesting that you work with a mediocre person and pick them up, but life is too short not to work with the best people. And the best people invest in themselves, and they will do partnership planning when you're a key driver of revenue and all the rest of it. But, imagine if I do an email introduction that says to the client, and then carbon copies you, and it says, "Hello, financial advisor. Thanks for taking the time to speak to me today. I'm glad to hear that you are still taking on new clients, and I appreciate you and your team taking the time to review this client's holding. This client has an opportunity to improve their household net worth through more effective tax planning, and I suspect the investment funds with the amount that's there are not being optimally managed based on a cursory review, and there's not been a formal financial planning process followed." By the way, we talk about AI and all these other things. We know that we can't compete on stock analysis now compared to software. But the financial planning piece is where we add the most amount of value, in my opinion, integrated offerings. So, and then you're saying to this person, and again, imagine, someone like me who most people would perceive to be an expert in my respective role, is saying, can you provide your expert opinion, as it does not hear the I'm going to learn how to speak for the next webinar. It's going to be amazing. The does not appear to have that comprehensive level of wealth management that I like to see followed. Here's their contact details. And then I say, you know, if I was Dan, for instance, Dan is a graduate of like too many programs for me to list, but, you know, has the following degree, the following education, and they're complete experts of what they do. I trust you to make sure they're well served. Now, is that the type of introduction that your mortgage professional, your lender, is sending over when they're trying to either make sure your clients are well served and making sure that you're going back to be the key CFO in the process? Is that the kind of introduction they do, or do they just say, hey, by the way, I talked to Mr. Smith today, he's got investments, follow up with him? But the point is that you have to have refined systems, process, and procedures so that you can deliver great value adds, consistent branding, consistent messaging, ultimately with the core purpose of making our client feel happy and making them know they're well served and they're working with a professional. So other way around, right? So imagine you're actually a financial advisor now, and you refer off your lending partner. So this is something that, a advisor that I work with sends over, and it's, dear client, as part of our 5-star service package, this client, sometimes advisors will capture it. They get a new client, they put their mortgage renewal in, they update it. Some people will be, they're reaching out when they do their quarterly reviews with their clients and know they've got a mortgage renewal, refinance, or purchase coming through. So the email goes out as part of our 5-star service package. We have all of our clients who are reviewing their mortgage needs connect with Calum Ross. Calum is a personal finance expert who specializes in mortgages. He's been ranked as the top producing mortgage professional in Canada before, has personally funded over $2.5 billion worth of mortgages in his career. He's an MBA finance from the Schulich School, best-selling personal finance author. He runs a customer-centric business. Spending 5 to 10 minutes on the phone with him will make sure you have the most holistic review and ensure your mortgage financing is properly in order. I'll make sure you get a direct introduction to him so you're automatically coded as a VIP client to his office. Please let me know if I can better serve or assist you along the way. So you think about that. And I mean, it's not disingenuous. I have an authentic relationship with all my referral partners, and I don't work with people who are not purposely trying to make sure that we are enhancing the customer service experience and helping each other grow our business. But what would your financial advisor practice look like if that was the type of referral and the type of introduction? And the other side of it is, keep in mind, what would your client think if someone else had done that introduction, they came to me and they weren't working with a financial advisor I know? Do you think your assets would potentially be at risk?
Next, Calum, you mentioned the idea of process. This is so critical that for an advisor, for a lender, that you've got these processes in place. I mean, everything we train on is processes, but this is how you don't allow clients to slip through the cracks. This is how you ensure you build the wall around their financial wallet. You bring your experts in to help maintain that wall, and you don't allow, you don't go for lazy types of introductions. You make sure they're very professional, they're laid out, and there's a process to follow up, both from the advisor and the lender's position.
And Dan, to build on that point, it's a compliance-based thing. It's a customer service. You can't leave these things to chance. The beginning, I was always trying to, morph these things. And then I realized that if I didn't have refined systems, process, and procedures, I couldn't deliver a consistent customer service experience, in which case I wasn't referable or moving forward. The other thing too is I'd interject on this is just briefly on the previous one, you don't have to pull it up, Dan, but when I've got a client who comes in and they are not working with an advisor I know, I am converting on a very bad month 50% of those clients to have a consultation with one of my advisors, and sometimes 75% and more. So, and the people I'm putting them in touch with, by the way, are great advisors. So I want people to be mindful of this. Now, keep in mind too, right, on the other side, I have to feel comfortable, and your lender partner needs to believe in you, and you need to believe in your lender partner. But when a client comes in, the very first thing I'm going to say, and we could say, let's say it was Dan. Congratulations on your choice of the Dan Carlson as a financial advisor. I only work with a very select number of advisors. I specifically chose to work with Dan because of the fact I believe in his business model, and I know he always puts clients first. As a referral from Dan, you're automatically a VIP client for me, and whether you use my office or not, I will always be happy to serve and assist you in any way I can. To make sure that we have the opportunity to properly answer your questions, please let me know 3 or the times over the next couple of days that I can have a 10 to 15 minute call with you. So, and obviously verbally you could say that or email, but you think about the client standpoint, they look and I've got a credible resource and all the rest of it. And the very first thing they do is they get an acknowledgement email back from me. That client does not feel they're being shuffled off. They feel they're getting a proverbial hug. And believe me, when they call, they will get that proverbial hug because I'm immensely committed to that cohesive customer service experience. And again, this is not about necessarily business generation. This is about making sure that we are the best of the best. And, even someone at Dan's level of expertise, he wouldn't even have deep knowledge in all the individual elements. So,
Absolutely.
Okay, so the next one is coming back here. I want to spend a little bit of time again coming back on the key benefits here of financial advisors and why they need to do this. Again, is that they have mortgages and they want to make sure their assets under management are protected, but also enhancing their customer service offering. And this goes for all the other people under the personal CFO model. Like, how different would your customer service and what would your business look like if each one of your strategic partners, the people who fulfill your CFO, your direct reports, if you will, how different would your customer service process be? How different would your business look like if each and every one of those core components under the CFO model were referring you and working cohesively with you in a unified customer service experience like that? How happy would your clients be? What would be the probability that you would retain that client as we have an intergenerational wealth transfer? And it's important for people to also pause for a second here to understand that a mortgage lender typically gets them earlier in the client life cycle. So, you sit back and you think about the idea of the client who comes in, they probably need mortgage advice more, maybe later on they're doing borrowing to invest. But by the way, what happens once their kids come out of school and they want to gift money for down payment, they want to help, and you've got your mortgage person dialing in early, the probability of you getting an intergenerational wealth transfer and having them not go to another advisor goes up dramatically. So the second one here is incremental AUM from home equity or for the clients is a win-win. So borrowing to invest or a leverage wealth strategy obviously is predicated on someone being financially and psychologically able to do that. It's not a fit for everyone, but it's going to move from the idea that people used to think it was a sexy strategy, and it's going to move into the point where the CFO is going to say it's going to be a required type of strategy for people to effectively achieve the critical mass of assets under management that they will need to maintain the lifestyle that they have gotten used to during their working years. Okay.
And along with that, Calum, what we recommend to advisors, if you're not talking about all of these strategies, some other advisor is. So if it's not appropriate for one client and you don't talk to them, another advisor could still be selling your client on that strategy and pulling them out, and you're losing the AUM. So as important as the strategies are, it's more important to communicate. You have to be able to talk to the strategy. You have to have the expert to back you up if you're going to go through with that strategy. But absolutely, these strategies are critical to talk about, even if the client doesn't qualify for whatever reason.
So interesting, and I want to just interject there. This wasn't planned, but my chatterbox, I was going to go over Dan. Yeah. So first of all, I had done this partnership with Fraser Smith around debt swaps and all the rest of it. And at that point, I was doing my mortgage business, mostly working with realtors and otherwise. And I've had this happen 2 key points in their career, really simple times. One is that a client, a couple times come back to me and go, Calum, I really wish you did cottage mortgages. When I bought my $2 million property in Muskoka and I had to deal with their local bank branch for that $1 million mortgage, I really wished I was working with you. And I was like, super qualified client, went away. And a simple thing, they didn't think I did cottage mortgages because I helped them with their principal residence. And I've got another one where it's this client was like, ran into me in the mall, or, I didn't do my mortgage with you last time because someone was showing me how to do tax deductibility and mortgages. And I really wish you'd done a strategy like that. I was literally the guy that got Fraser Smith published in the first mortgage publication. I built a huge business on that, but I lost a client because they believed I didn't have that expertise. So I think it's important that we always realize that clients actually don't think about these things. And it's so important that we let them know the scope of products and expertise that we offer so that when they have that related question, they come to you. And even going back the next level, which is obviously what Dan Collison teaches people, is that, be the CFO. Let them know that if you've got a personal finance related question, not the, I know you use the dollar sign piece. If you've got anything, personal finance related question, call me, whether I can answer it or not. If I can't answer it, I will put you in touch with a top caliber professional who will make sure they can, and I get you the right answer. So coming back again to the advisor segment, you imagine about identification and third-party validation of underperforming real estate for incremental assets under management opportunities. So I have a huge portion of my client base that have real estate investments, and a ton of them right now, when they actually have their mortgage coming up for renewal, I'm actively encouraging them to say, hey, by the way, just because you bought that property and you made money, sort of like a stock, you buy a stock and you bought Goldman at 180, it hit 220 yesterday. Should you actually be holding that still? And by the way, I don't give equity advice. I don't ever step my financial advisor ever, just to be clear. But asking person, in the universe of available real estate investments today, would you still buy that property? Would you still own that property? And then, encouraging people to think through that process, because if you look at the yields on all these assets and you consider the amount of, literally hundreds of thousands, millions of dollars, trillions across the country of home equity that is essentially sitting dormant as a massively huge underperforming asset, it's a game changer for customer service experience. And I'm going to put this out there, and I want people to realize, the vast majority of people who've succeeded in real estate investing in the last 10 years were just the right place at the right time. They weren't actually good at real estate investment. They were just, the right class. It's like Dan saying, I'm an A student. Well, if you found out the average was A+, I wouldn't seem that smart, would I? When Dan was probably giving people C+, I look reasonably bright. It's important that people realize it's not just like their investment returns. What's their risk-adjusted rate of return? How do they do compared to the other ones? So the final point is cost of capital analysis and more integrated mortgage offerings. So, are you purposely going through and saying, what is your after-tax cost of borrowing? What is your after-tax rate of return? Should we be doing more income splitting? Should we be using spousal RSPs? Do we want to look at dormant home equity? Do you want to downsize? The point being is that we're all in this together. And it's really important that our ultimate value proposition is happy clients that achieve at or above their stated financial goals. And the point of this is that we can't ever know it our own. So, my closing thoughts is, again, I believe the lender's number one priority is to make you look good. So as you can see, I go to great lengths to make sure that financial advisor is elevated and the firm is elevated. But at the same time, I have to work with people who I believe in. I can't give a passionate endorsement or sell a product I don't believe in. And then, for the people out there who are financial advisors or the mortgage professionals that may be in fact interested in this, my independent service offering gives people diversified mortgage options, sometimes lower rates, but it also means, you're not going to put in assets under management competition. And then, I think this is a sports analogy or whatever, but people need to realize that your team is only as strong as your weakest link. So if someone is not using the same type of client education, the same customer service model, and you guys don't have a very clear line in terms of who handles what, when, and how that works in terms of a process, then, you're ultimately not doing your job as a personal CFO. And again, that first job is they're the CEO. We ultimately are here to serve our clients and add value to their lives.
So we're running out of time here. We've got so much information that I think you've given the advisors and the lenders great ideas to think about. Calum, really appreciate you coming out. For all of you that are actually taking up the mantle of the personal CFO model, now you see what kind of specialists that you need to have in your corner, because they're thinking not just of their business, they're thinking of your business, and combined, you're both thinking of your clients, the CEOs. And if you're not doing absolutely everything these days to take care of that client, absolutely there's someone else that will, and they will do it readily and they will do it quickly. So Calum, thank you so much for all of this information, for your insight, for your ideas. Again, folks, keep in mind that the way you get out to market is as important as what you know about your market. And one of the easiest ways to prospect is come up with some technical questions. And again, here's where you're able to work with some of your specialists to create these technical questions that you can ask the right prospect. So long as they fall into your ideal client profile, you ask them the right questions just to get the opportunity to sit down with them. And then you're going to get the opportunity to do a full discovery. So before
one more thing, if I could interject, Dan, for a second.
Go ahead, Calum.
I want people to realize too, right? So Tina, Dan, I got a copy of the first chapter of my book. My publisher has said that they can distribute it out. So you guys are welcome to put that on a website so they understand sort of some of these fundamentals, because real estate investing is a topic they have to have a functional understanding. Keep in mind too, if you do buy my book on Amazon, all the proceeds go to Sick Kids Hospital and the publisher. Not a penny goes to me. If you want to advance your education. The other thing I wanted to just quickly pause on, there's a lot of mortgage people on the call, and I know that you've got some products or services. Now, I don't expect people to be like, me taking tons and tons of personal finance course, the rest of it. But, you think about yourself as a mortgage professional, why haven't you invested in a functional understanding of how financial advisors prospect, or, keep PowerPoint decks and things, so that you can be mindful of what the other industry peers, whether you work with them or not, understanding the basics of personal finance. And ultimately you go forward and you come to a financial advisor and you show them how to build their business. There's a dramatic opportunity there. And, I know that this is stuff that you preach, Dan, but as we know, the people who need the advice the most don't invest in themselves. And then of course the top people are buying these things all the time. So the mortgage professionals could have a lot of benefit from some of your products.
Yeah, beautiful. Thank you. Great segue, Calum, because the reality is, yes, we do have some offers. And just as Calum mentioned his book, we'll get that chapter put up on our website. But I would suggest have a read of the chapter, but get the book. As Calum mentioned, you need to know the world the expert lives in as the personal CFO, and the experts need to know the world that you live in so that you can coexist and serve your client so much better. So with that in mind, what we're offering today, we've got two different web-based video programs that we put out. One is our Prospecting Genius. This shows the 4 different methodologies that the top financial advisors across North America use, and they use it effectively. They become referable. They don't ask for referrals. They ask for targeted introductions to their ideal client profile. They build personal networking groups with other like-minded experts who serve the same clients, and then they do seminars and now webinars. So this is a 5-part series that goes in depth into how you become very confident in running and doing these methodologies that take very little time and cost you almost no money to build your business. This is regularly a $299 program. Tina's marked it down to $199 for today only. And then we've got our big program, our Master Series, which goes far more in depth. It's a series of 8 videos. It actually gives you 8 CE credits when you complete it and do the quizzes. You'll love this one, Calum, because they're doing quizzes to get their 8 CE.
Of course they're doing quizzes. Otherwise you wouldn't let them have the program.
Get away from them.
MBA.
But this goes for financial advisors, and again, as even Calum mentioned, with you lenders, talks about tax planning, investment planning, risk management, retirement, estate planning, all areas of technical planning, but then how you take those technical areas and turn them into prospecting opportunities. Because again, if you're not learning to use this technical information, it's an absolute waste of time. Now, the one thing I've got to, Tina, you've got it down as $199, right? Because this is usually
Yes, I do.
$99 program.
$7.99. That's right.
Okay, so that
I would love these things. Do I get it for free because I did the speaking? I gotta ask. While
hey,
you're both
just
on,
for that segue, you get them, Calum. Absolutely.
Yay.
You still have to do the quizzes though, Calum.
You know what? If I could get through his MBA finance course, I should be able to pass these. I hope.
But then again, okay, so for today only, you can have both courses for $350 plus HST combined. So go onto our website, www.advicetoadvisors.com. You'll see Calum's chapter there. And again, read the chapter, but get the book, because we've got to know that lending space perfectly. We don't have to be the experts, but we just have to know how to work with the experts on behalf of our clients. So I think that pretty much wraps it up, Tina. And if I'll turn it over to you for any questions that might be there.
Yes, absolutely. Thank you so much. So there are a few links in the chat box if you haven't noticed them already. We've got Calum's book. It's a preview, and I see quite a few of you have already gone to our website to download that. So thank you very much. And then we've also got the 2 programs and the offerings today that are on the chat. So have a look through. And questions. Yes, our first question is from Steve. Calum, this one's for you.
Okay.
Should people be investing in real estate given today's historically high home prices?
You know what? My answer to that question, one would be difference between a principal residence versus an investment property. To me, when you're buying a principal residence, I don't view it as an investment. I believe it's an expense. But I mean, I would suggest that the vast majority of people who are doing real estate investing today are actually not following the principles that I would teach in that book, because as real estate values have gone up, the rent rolls have not gone up. And in fact, in Toronto, we recently, in the last 2 months, rents have been coming down and values are going up. So if you think about, I look at real estate as a way to replicate a bond within an investment portfolio, and or have an ongoing, it's like a pension, right? It gives you a monthly annuity once you roll forward. So if you're buying a negative cash flow piece of real estate, which is the vast majority of real estate investments today in these areas where values have gone up and rents have gone down, or if you were looking at it as a, a hybrid dividend paying stock, if you will, if you look at the yields, they just don't make sense. So I'm not saying it's not about real estate investing, but when I bought a good portion of my real estate investments, if it went below a 10% yield, we were like, oh my gosh, I don't know if I should buy this. Can I get it up? But, when I start to look at real estate, people calling themselves real estate investors and they've got negative cash flow and they've got, a yield of 3.5%, they're not real estate investors, they're real estate speculators. So it's like an alternative investment. You can have a portion of that in your portfolio. But the answer would be, the vast majority of these people need to understand real principles. They think they're real estate investors, and in fact, they're real estate speculators.
Great saying.
Excellent.
Yep.
Thank you. Okay, we've got another question that came in from Mike. Should consumers take a fixed or variable rate mortgage when getting a mortgage?
I assume this one's for me. You didn't say it was, but unless Dan.
It's for you.
You take it, Calum.
So it's really important. I want people to realize this answer. I've said all the time. Should people take a fixed or variable rate mortgage? The answer is yes. They should take one of the two. And that's not to be evasive, but no one can time markets. But what I would point out is that we look at a situation like today. Yesterday, we had the Bank of Canada going on record saying unequivocally low for long. The other thing too is the Bank of Canada governor literally said, if you are a consumer and you're a business person and you're thinking about taking out debt, please understand we will not be increasing rates for a long period of time. First time in history they've ever said that. So I point this out because we've got fixed rates. Make no mistake about it, fixed rate mortgages will not actually go down from where they are. The 5-year Government of Canada bond yield is at a low. We said we're not going to go into negative interest rates, and I want people to realize there's not a lot of bandwidth there. So if you were going to time a fixed mortgage, it might be a good time to do it. On the other side of it, on a variable rate mortgage, you sit back and you look at the Bank of Canada has said unequivocally it will not be raising rates for a long time. And National Post has said 2023, before it was 2022. They've never taken that stance. So the certainty that a variable rate mortgage won't go up. But to me, it comes down to ultimately serving the client. And you ask the person, the only difference between a short and a longer term mortgage, the longer term mortgage is effectively insuring you against interest rate risk. So I might ask Dan or you and say, okay, if you've got a $400,000 mortgage and this is the difference, it's effectively costing you $100 a month for insurance, not worry about interest rate risk. You might get a husband and wife who has different opinions, or you might get someone who's like, for $100, that's a no-brainer. We're going to take the interest rate insurance. Other people are like, that's outrageous. So it comes down to financial and psychologically, but that's the dynamics on the fixed versus variable rate market. Does that properly answer it? I'm not trying to be evasive, but it comes down to the consumer and then looking at the market demand, and the spreads between fixed and variable.
Absolutely.
Excellent.
Tina.
Okay, the next question. I'll take care of the next question. It's actually, I'm going to answer 3 at one time for Curtis, Dennis and Tara. Yes, there will be a recording of this, and thank you very much. We'll make sure everybody gets a copy of this video. It'll be on our YouTube channel, but we'll also follow up with the link to make sure you get it. It looks like
I've arranged for a window cleaner to come at my window right at the back of the presentation.
Isn't that perfect? Timing's everything, Calum.
that's amazing.
Make sure it was a great close.
Excellent. We've got one last question, and again, it's for you, Calum. It's from Sandra. What is the best strategy for consumers today? Should they pay down debt or invest?
You know what? I mean, it would depend on, to me, their tolerance for risk and the types of investments they're looking for. And of course, with their debt, it's, what is their interest rate? What is their after-tax rate of return? If we're always mindful of, do they financially and psychologically fit the profile? And if you looked at, even you could get, for instance, right now, you could get a 10-year fixed mortgage below 3%. Unbelievable, unheard of. Okay. Now, if you're at a 40% tax bracket, again, you're talking about an after-tax cost of borrowing guaranteed for 10 years of less than 1.8%. And so, you ask an advisor, could you get a better than after-tax rate of return, 1.8%? There's a pretty compelling case to borrow to invest today, as opposed to being mindful and paying down debt. But of course, the caveat is, do they financially and psychologically feel comfortable with it? And they understand that, leverage does magnify returns, but it also magnifies losses. So they need to be mindful of that.
Perfect.
Great.
Any other questions, Tina?
That's all the questions we have, Dan.
All right, so I think we're going to wrap it up. Again, thanks all of you right across the country for joining us today. Calum, it was great to have you on, and really do appreciate you stopping by and spreading out some of your expertise. And again, folks, go to our website. You can pick up that copy of the chapter from Calum's book. And once you've read that, you'll probably want to get the book. You need to be knowledgeable on that side. So until next time, Calum, Tina, thank you very much. Everybody, thanks for joining us. We will see you next time. Take care, all.